Live stream. Awesome.
Welcome, everyone, to Name Confidential Live.
Hey, everyone. Welcome to Name Confidential. I'm this week's host, Ryan Redfern. I'm filling in for Ben Fox, who could not be here this week. And today we have the amazing Rob Hanna from Quantifiable Edges, also Capital Advisors 360. If you know me, anytime I talk about the Name Exposure Index, I bring up this guy's work. I think it's just fantastic. Awesome to have him again this year. We talked last year, which was a lot of fun. Let me switch over to the Exposure Index and we'll check that out. And I think we have a great treat. You got some extra data on that to talked about there today, Rob.
Yeah, I played around a little bit and we got a little model
I
to
love it. I love it. Well, this week the exposure index is back, up to 79.49, it looks like. That's a pretty good number. It's bouncing off that 60, that key level, the key quintile, I think it is. Um, I mean, I personally reported 100% this week, so I'm helping bring up that average.
All
Do you
right.
report to this, Rob?
I haven't reported to it on a regular basis, but I think I
Okay.
am going to start doing it. Previously, I thought since I do a lot of swing trading
Yeah.
that I would kind of throw off the number, but uh, I'm not as worried about that. So I think I'll
Yep.
probably start reporting to it soon.
You should. You should. If you manage money, might as well throw it on there.
That's right.
Well, cool. Let's look at what you got. I know you have some neat information about how to look at this exposure index and how to make it work. Uh,
Okay. Let me try and share it.
sure. Current one.
Is it
Deviation
working?
possible.
Can you see my model here?
Uh, there we go. Got it. Yep.
Okay. So,
Oh, nice.
you and I have talked before, and one of the things I found in the past was it can be contrarian if it's everybody's bearish, right? If it's real low, but also if there's a lot of people that are bullish, it's not contrarian. It's actually, a continuation signal a lot of the time.
Right.
And so what I did is I created this little model here, and we've got three signals behind the model. Now, and they're all based completely on the name number. Uh, there's no filtering for what the S&P is doing or anything else. So we just wanted to see, can we build a model using the name survey that can provide some value? And so the three signals, I don't know if you can see my pointer down here. One thing I do with some indicators, and I like to do it with surveys. So I tried it with the name survey here, is that rather than using the raw number, I did a percent rank of the last year, right? Because the people that are answering the survey now versus in 2007, a lot different people. And um, there might be more people that are prone to get leveraged these days than back then, or there might be more people that, within the survey answers that actually do short as opposed to back then, right? So by putting it in a percent rank over the last year, it's kind of an adaptive
Nice.
number for you. And so you're seeing, hey, are we really strong versus recent times?
Mhm.
As opposed to just comparing, today's number to numbers that occurred 10, 15 years ago. Um,
Cool.
and I did find some value in that. So this first signal says, hey, if the number today is in the bottom 10% of all the numbers of the last year, and it's still not falling,
Mhm.
we're gonna go long, right? So basically that means rather than just look for a really low number, catch a falling knife type thing, you're looking for confirmation that people are pretty much sold out, right? And either it's started to tick up or it's leveling off. And so if it's down near the bottom and it's not going down anymore, it's probably going to be going up. And that means more people are jumping into the market and there's reason to buy whatever their models are. And you got some smart people behind these models, and
Yeah.
you probably get some momentum up. So that's the first signal. The second signal is what I call it's like a bull thrust signal. So
Okay.
it's risen at least 15 points over the last week,
Mhm.
and the name number is above 80. I'm sorry, 15 points over the last 4 weeks, and the name
Okay.
number is above 80, right? And then the last one is just an extreme if the name number is at least 100. So if people are so bullish that they're getting leverage, that's a good thing also. All right. So one oversold signal, two overbought. And then all the model does is it goes in when any of those signals triggers. And if none of those signals are triggered on the following week, it pops out and goes to cash. So the green line here is returns of the model, and the gray line is just the S&P 500. And it goes in 150%. It doesn't just go in 100%. We're
Okay.
talking about, uh,
Sure.
and the reason it does, part of the reason it does that is it's only in the market about 19% of the time.
Oh, wow. Right.
Okay. So here you can see the performance metrics, but it's averaged 10% a year versus a little over 9 for the S&P. Volatility is lower. Your drawdown is significantly lower,
Right.
right? 19% versus 54. Better Sortino, better Sharpe ratio, better Calmar. Um, and obviously your final equity is bigger and you're only at risk less than 20% of the time. So
That's wild.
yeah, and I think, to me, it's not, this isn't necessarily something I would be like, all right, I'm trading it with clients' money,
Right.
right?
Sure.
But it does demonstrate that there's value in the numbers for people.
Mhm.
And I think that's, what people are looking for when they're looking at something like the name survey. And actually I have another one. I did a second version of this, and I'll just
Oh,
show that
nice.
quickly. And it's the same entry signals. The only difference is here we're holding on instead of 1 week. If you get a signal, you're holding on for 4 weeks.
Okay.
Okay. So rather than jumping in and out, people like to 1 week hold is short for some people. Not for me, but for some
Right.
people.
Exactly.
Right. But there's a lot of monthly models. And I said, all right, so if we've had a signal within the last 4 weeks, we're in.
Mhm.
And it's only once you go 4 weeks without any signal that you're going to go flat. And in this case, you'd be in the market about 48% of the time. You can see that here.
Right.
And it increases the return to 12.5%. So it's, 3.4% per year better than the S&P.
Mhm.
Volatility now becomes about even with the S&P, annualized volatility, but max drawdown still less than half.
Yeah.
So, and you still have nice, Sortino and Sharpe ratios.
Mhm.
These numbers aren't quite as good as if you're just doing the 1 week hold, right? The
Sure.
risk numbers, but final equity is higher. But again, not really trying to maximize the model,
Right.
just trying to say, hey, is there value in the numbers? And
Yeah.
to me, the answer is yes.
Nice. So is the signal typically on the Friday following the number, or is it on the Thursday when it comes out?
It's the Thursday when it comes out. It comes out
Okay.
in the middle of the day,
Right.
right? And so you got to enter or exit on the close Thursday. So
Hmm.
you need to pay attention. Otherwise, I don't think it would make much difference if you did your entry and exits on Friday morning as opposed to Thursday afternoon,
Sure. Sure.
right? You get some
No.
slippage with each one, but it's sometimes it'll be positive slippage, sometimes negative, and it's not gonna it's not gonna matter a whole heck of a lot.
Right. Right. Well, that is really cool. Really neat. Another neat way to look at it from Rob Hanna. See, I'm going to reference you even more now.
All right.
Well, awesome work on that. Yeah, I mean, this is very valuable. Not sure what to do with that. It's just cool stuff. Neat to see proof of concept that it is there is value in that index.
Right, right. And that's and it's encouraging to me that, and we saw it, other ways in the past, but real strong numbers aren't indicative of a pullback,
Mhm.
right?
Right.
And that's interesting because some other investment surveys they are.
Yeah. Yeah. AAII, for example.
Right.
But they're much more emotional driven. If you follow that one closely,
Yeah.
and lately it almost feels more politically driven than anything, than actual um,
Yeah,
data.
they're still real low, I think, right? Wasn't it like 40 some
It
percent this
it took
week?
them a long time to get unbearish, and they missed that whole run last time. But then of course there's a sentiment versus actual exposure index, right? The name indexes are how people are actually invested.
Yeah.
AAII is more like what's your opinion about how to be invested, it's not the same thing.
Right. Right.
Anyway, good, great stuff, great stuff. Thanks, Rob. Thanks for showing that.
Yeah.
And of course, so let's gonna go on to the basic background of Rob. I know we've talked before, and you've been on this a couple times. So just real brief for people who don't really know you yet. Give quick highlights on you, and then how do we get to your investment philosophy, and then we'll dive into some charts you brought.
Okay. So I've run a site called Quantifiable Edges for since 2000, beginning of 2008, I started it. So it's been a long time. Um, and I started managing money back in 2001, uh, a hedge fund, uh, a small, private partnership. And I ran that for 18 years. And then in 2019, I shuttered it and uh, joined Capital Advisors 360. And several of my clients came over there with me. And the advantage of doing that basically was that I can manage individual accounts rather than have everybody in the same strategy.
Right, right,
Right. So I can cater to individual needs, and we can get more aggressive, less aggressive,
yep,
and trying to fill gaps in people's investment philosophies. And a lot of my clients these days are people that know me from quantifiable edges too. So uh, either traders or former traders that they trade differently than me and want me to trade a portion of their book
right.
with my strategies because they see value in it. They see value there, and but it's not their style,
Mhm.
uh, but it's not correlated to what they do, and so it can be helpful for their overall portfolio. So that's a lot of what I do.
Right, right. And
Uh,
your strategy is a little more mean reversion than trend following, if I recall.
I've got both
Hmm.
types of models, um, more mean reversion
Hmm.
than trend follow. Yeah,
Sure.
so I've got a good number of mean reversion models, and then I've got a few trend following models. And then I also do a lot of trading with the VIX, so volatility based models. So those are and those tend to be short term.
Right, right. And then I know on Quantifiable Edges, you actually have courses, and I've done a couple, and they're fantastic on there. What are the kind of things that people can learn about on Quantifiable Edges?
Oh well, the VIX trading course is probably the most
Mm,
popular.
right.
And that teaches ways to take advantage of VIX trading, whether it's using ETFs or futures or options,
Hmm.
and a lot of different inputs that go into that, and indicators that I look at,
Right.
and I do a deep quantitative dive into a lot of indicators in that course, and then I put
Hmm.
together some models for people
Yeah.
that they can follow. My name uh, paper
Hmm.
from a couple of years ago. You can also download a quantifiable edges, and that'll give you kind of a preview of the kind of ideas that I have in the course. There's a little bit there, so if people want
Hmm.
that, that's free. I think you can download it at the name site, or you can
Hmm.
download it on SSRN.
Yeah. No, fantastic paper. Well done on that. I know we talked a lot about that last year, so we don't have to dive
Okay.
into it today, but yeah,
Okay.
great course. And I
Thank
think
you.
people who are new to active management should really check out some of your stuff because I think you do a great job of showing how it's not. You always get like the public, big people saying, "Oh, we can't beat buy and hold," and I think you do a great job quantifiably showing that you really can, and it doesn't take a lot of work.
You can't beat buy and hold if you're really lazy,
Well, well, right, right,
right? But I mean, there's so many ways to beat buy and hold. I
right.
did a presentation a few years ago. It may still be on YouTube. I don't know. But I should redo it at some point. It was like my top 5 ways to beat buy and hold.
Right.
And all of, I think the number one way was just use a long-term trend filter.
Mhm.
Right. And I showed how
Yeah.
over a long time horizon, any of them beat it. Like if you want to do a golden cross, or you want to do a 200-day moving average, or you want to
Right.
do a 1 year rate of change, you can beat buy and hold with any of those things.
Yep.
So, um, uh, and then, you can get more complex from there. And I generally do, but
Yep.
as a baseline, it's not hard to beat buy and hold.
No, no, I think that's fascinating because I get so much push, not a lot of pushback, but occasionally people who are just like, they believe that it's impossible, right? That the S&P
Right.
500 is so efficient and perfect, you cannot possibly beat it with active management. So,
Right. And the other thing that people say is that, well, if you want to beat it, you got to take more risk than it.
Mhm.
Right. And that is
Right.
so not true.
Right.
Right. Really, what you can do is take less risk and beat it. You
Right.
know, for instance, look at a model that's in it 19% of the time, and,
Right.
and it's got lower drawdown. I mean, we just showed it.
Exactly.
And
And
that was
uses leverage, and it's
right.
still
And
less fault. Yeah.
yes, so that's a pretty simple model based on one indicator being a survey. So yeah, if I can beat it with the name exposure index, there's plenty of ways to beat it.
Oh, exactly. Exactly. That's I love it. Love it. Well, I know you got some slides here. Now we're going to talk, dive into a little more specifics about how you use active management.
Okay. Well,
So
yeah.
yeah, go for it.
I'm going to talk a little bit about like today's market, and we've had a runaway for the last few
Mhm.
weeks here. It's been
Yeah.
pretty astonishing. Uh, and I'll talk about what I haven't seen towards the end of this, but what I have seen is a bunch of what I call price thrust studies, right? So we've got real persistent moves higher. And what often happens is that when the market gets overbought, you start to see odds saying, hey, it's likely to pull back, right? So
Mhm.
it's too overbought, it's going to pull back.
Yep.
Well, when overbought becomes overbought enough, then that changes. And it's rather than overbought likely to pull back, it becomes strength is likely to get more strength. And so starting on April 7th, I started seeing many of these studies. And I just pulled these from the Quantifiable Edges subscriber letter. And so I'll run through them pretty quickly. But
Cool. Okay.
April 7th, they're going in order of when they fired,
Mhm.
right? So on April 7th, I saw this one fire, and it was just after a 50-day closing low. The S&P goes higher 5 days in a row, and it closes below the 200-day moving average, right? And what I saw here was, hey, you look out 4 or 5, it's not that steady the first few days, but you look out 4 or 5 weeks, and it's almost always higher. So that strength begetting more strength, right?
Right.
The next day, I saw one trigger that uses RSI2. Now, RSI2 is a real short-term indicator, and it's normally used for mean reversion. So
Mhm.
um, people that use RSI2 will be getting out when the market reaches 50, 60, 70, 80, whatever.
Yep.
And they'll often be getting in when it gets real low. But when RSI2 gets really, really high, in this case, over 99,
Hmm.
what we see is that, again, is an intermediate term positive, right? It's up 75% of the time 3 weeks later.
Mhm.
Um, And then here's a profit curve of 15-day hold. So you can see that it's been pretty smooth over time. That overbought, really overbought, sorry, RSI2
Mhm.
means we're probably continuing to go higher. Uh, the next day, April 9th, the market just keeps going up, right?
Mhm.
So uh, now I had one trigger that says S&P's higher for the 7th day in a row, and now it's above the 200-day moving average. What's happened here? Well, again, um, short term is iffy. Look out 4 weeks and you're up almost 80% of the time. So we're continuing to see these price thrust type triggers. And here's the profit curve for that one. Oops, I mislabeled that. Sorry. It wasn't the RSI one. Oh yes, it is. Sorry. I went in the wrong direction. I hit my up arrow instead of down arrow. All right. So this is the 7th-day higher curve. It looks a lot like the RSI2 curve, right? It just goes from lower left to upper right pretty much in a pretty smooth manner. So over time, these signals have been good. April 10th, we had another one. Finally, this was the first day that the S&P closed lower. The NASDAQ still hasn't, by the way. But, we had one down day, and this said, all right, it's up at least 5 days in a row. It hasn't yet hit a 50-day high, but it's down today, and it's above the 200. So again, you look out 14, 15 days, and you got really good numbers. Again, a profit curve saying, hey, you know, the run up from here over the next 15 days is often about 3%. Wow. Your drawdown stats are shown there as well. And that's only about 1.5%. April 15th, we really saw something interesting, I thought. So the S&P 100, I'm sorry, the S&P 500 and the NASDAQ 100 and the NASDAQ composite, I think, both went from a 100-day low to a 200-day closing high. Actually, they both went to all-time highs in 11 days.
Right.
And the S&P had never done that before. So, you know, it's the old, just because it's never been done doesn't mean it can't, right?
Right.
Like,
right.
And the NASDAQ 100 had did it once, and that was in 1985. So that was pretty awesome. You can't glean much from a sample size of one. So to get a larger sample size, I said, well, what if it was, well, let's broaden the scope a little bit and see if this kind of move from an intermediate term low to an intermediate term high means anything. And so I looked at the S&P going from a 50-day low to a 50-day high in 12 days or less. And again, the numbers there were great, both short and intermediate term. So 15 days out. Again, this is, you know, what we were seeing for a lot of the other ones. So it's just kept pushing higher and higher and higher. And so strength begetting more strength is what we've seen over the last couple of weeks.
Oh, for sure. For sure.
Right. And that leads me to call it the Scranton Party. Office fans will know this one.
Fantastic.
Party. Yeah. So that's kind of where we're at. And we're, you know, today's up and away again. So I will note that most of those studies are looking out 3 or 4 weeks. And the early ones have already hit what would normally be their, you know, their average run up. So from my standpoint, any further gains might not be attributable to what happened a week and a half ago.
Yeah, fair.
And none of them, you know, are predicting what happens over the next 6 months or year or anything like that on a highly reliable basis, in my view. What does predict that often is breadth, and breadth has been something that I'm a little concerned with in this rally, right? So like last year when we had the tariff tantrum and the market sold off heavily right around the same time, we saw a massive number of breadth thrust studies trigger in from late April until May. And that included a Zweig thrust, a Deemer BAM, a Whaley ADT thrust, the 770 thrust that I created years ago, and a DeGraff thrust, and there were a few more even. But these all triggered last year, and none of them have triggered to this point this year. So you know, we've got nice momentum. We've got a Scranton party going.
Right.
But we don't have the kind of breadth that would get me really excited for, you know, looking out over the next several months.
Right, right. And we have a minute. Do you mind diving into what your 7070 thrust is?
Oh, that's a pretty simple one. That's just if the up issues percent closes above, so the New York Stock Exchange
Okay.
up issues percent closes above 70% 3 days in a row.
Okay.
Okay.
Right.
And that's generally been good over the next few months.
Sure. Sure.
Uh,
So
the
it hasn't happened. It hasn't had that much movement.
No, and we've got a lot of days that have been
Mhm.
under 70, or like, yesterday we were up. Well, we weren't up that much yesterday, but we've had several days lately that it's like, hey, the market's up a bunch and the breadth is only like 60%
Yeah.
positive.
Right.
Um,
Interesting.
or in that range. It hasn't been the kind of thing where everything's ramping higher,
Mhm.
which is interesting. It's being led by uh, tech a lot, right? And
Mhm. Oh yeah.
so that's generally a good thing when tech leads.
Yeah.
Uh, but is it going to be able to, when you're coming off a bottom and you're looking for an extended
Mhm.
multi-month rally, it's nice to see a breadth thrust.
Yeah. No, for sure. For sure. Yeah, and yeah, I think the Nasdaq to S&P ratio is worth watching, and I think I learned that from you actually, and I use it all the time.
Yeah. So, and that actually had real good timing. It was,
Yeah, yeah, I did.
it was 2 or 3 Fridays ago, right? It
Mhm.
it triggered, and
Yep.
uh, since then the Nasdaq's just gone up, right?
Yeah.
It's up like 12% or something. It's
Right.
ridiculous.
Right. And when
Uh,
it crossed over earlier, it was a great, way early signal of
yeah,
being safe.
it was like October
Yeah.
or
Yeah.
November, and it stayed out for the whole kind of topping process, and then
Yep.
right at the bottom it triggered going along. So it doesn't always work that well, but it's been a
No, no.
very
But
yeah.
lately, yeah, that nailed it. So I'm
Oh, it's been a
grateful I have
very
that.
good signal over the years, and it's been real good the past year, like you said.
Right. See,
Yeah.
I'm plugging your course. I think that's where I learned it, wasn't it? Your market timing course?
Yes, the market timing course, which is now called it's got renamed the market dynamics course. So
Oh, well, okay.
if people are
Okay.
looking at it there, but I do cover that indicator in the course, and uh,
Nice.
it's um, it's part of uh, one of the models that I trade, a trend following model.
Yep. Yep.
That's similar to the models in the course. So, but I
Right, right.
trade
Fantastic stuff. And I
compliance
think
with
you have a
that.
chart on breadth as well.
Yeah, so I did a study of tops, and we talked about this last time, so I'm not going to get into it too much, but
Hmm.
the basic idea is that normally when you have a top in the market, breadth will um, diverge
Hmm.
prior to the top. Normally, like 2 to 3 months at least prior to the top, you're going to see some type of breadth divergence.
Hmm.
And that breadth divergence in my study, I looked at the advanced decline line, and I looked at the percent of stocks hitting new highs, right? And this looked back to until the 60s, and it looked at all uh, drops in the market. I was going to do 20%, and then there was a couple that were real close at like 19, so I included 19%.
Hmm.
But what I found was, other than COVID, every one of them saw a breadth divergence of a couple of months before the market actually topped.
Hmm.
So over the last, during this period of time, I was saying, well, to me, it seems unlikely that we're going to have, we're moving into a full bear market here. We're not likely to be down 19-20% because we never had a breadth divergence. As you can see, coming off the
Right.
bottom last year, the advanced decline line was at a high uh, after the January high, and same with the net new highs. And what this is measuring is it's the total number of 52-week highs today minus 52-week lows divided by the total number. So what net percent of stocks uh,
Hmm.
are making new highs? right? And that back in Zoom's covering it up, but I think it's January
Mhm.
or February. I mean, no, it was early February, I think. Was at like 15%, which was the high of the rally off of the tariff bottom. And today I was, hang on, I'll give you an updated number. So it's better today. This was 2 days ago. I did this chart. It was like 2.5%. Now it's at 6.6%, but that's still well off the 15.
Yeah.
So this isn't a trigger to get out of the market. This kind of divergence can last for months, even over a year. But what it does say is that when we have this kind of breadth divergence going on, we are susceptible to a large market top. Whereas if the advanced decline line gets to a new high, which I think it will, and this gets over that 15.5%, if this gets up to like 16%, now you probably don't have to worry about a market top happening for at least 2-3 months from that point.
Sure.
Right? Because you've got a lot of strong breadth coming in, and it's been increasing, and so we're unlikely to see a market top. But it's been over 2 months now since this is top, so we're reaching a point where okay, we're now in an area where the divergence has existed for long enough that we are at a point where we could be susceptible to a large pullback.
Wow. Awesome stuff. Awesome stuff. And
So
I know we're kind of at time here. So yeah, any last, oh yeah, of course, the investment quote. What do you got? What's your investment quote?
Well, I pulled this one from George Box. All models are wrong, but some are useful. And
Nice.
I thought that applied well to the models I showed earlier, right?
That is fantastic. That is fantastic. And then of course, how to find you. I think you've got a slide for that.
Yeah, you can
People
just
should actually check out Quantifiable Edges, of course.
Yep.
That's very awesome. And then, of course, I think we're going to see you at the NAAIM Uncommon Knowledge Conference on April 26th to 29th in Tampa, Florida.
Yes, very much looking forward to it.
That's about a week or so away. I'll see you. I'll see you there. That'll be a good time. It's always a good time. I enjoy that one a lot. So
it is. That's a good conference.
Awesome. So, well, Rob, great to see you. Great catching up with you again on this NAAIM Confidential webcast, and we'll see you in a couple of weeks.
All right, great. Thanks, Ryan.